You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, and you are in for a treat today. If you desire to be a successful private investor, self-directed, get free of the rat race, and build your net worth on your own, then you'll enjoy today's episode a lot. My guest today is Mark Zaret. He may not be well known, but he's quite successful, and that's why I brought him on the show. He was an independent musician and then found his way into Canadian small caps and built up a net worth via Canadian small caps. Mostly mining stocks was the bulk of that net worth gain. And so he's been doing this for several decades, or a few decades, I should say. And he's on the show today to share his story, as well as share his processes of how he screens and chooses junior mining stocks. So Mark, welcome onto the program for the first time.
Thanks, Bill. Pleasure to be here.
And I know your story will be an inspiration and very educational to my listeners. So thank you for joining me. Let's start with your background. I mentioned that you got into Canadian mining stocks and small cap stocks, but it didn't start there. It started as a musician, didn't it?
Well, that was my first career. I, at quite an early age, dinner time conversation did include stocks. So my dad was a businessman, and he would come home from work, and some of the dinner time conversation would be about various little episodes of investing in penny stocks and so on. So I was hearing about it and getting a little flavor of the scene as a very young person. So that sort of planted a seed, if you like, and that seed more or less lay relatively dormant until I was a fair bit older, had a family, and had recently purchased a home, and I was surviving on a marginal income, let's say. And as much as I enjoyed my career, I needed a second form of income, without doubt. And I was always a self-employed type. I wasn't going to be a 9-to-5, or I didn't really think that was what I was going to, the kind of life I wanted to have. So I walked into the bank one day, and at the, 4 or 5 years had passed since I'd managed to purchase a very modest little house. But given real estate prices at the time, it more than tripled in value. So that offered this opportunity of somehow finding a way to capitalize on this equity that I really didn't have too much to do with. It was just market conditions, and so I was somewhat surprised. But I walked into the bank and said, "Well, I'd like to take out a line of credit." And they said, "Why?" And I said, "Well, I for investment purposes." And they said, "Okay." And I walked out of there with a relatively large line of credit in my thinking at the time. And so I determined that what I was going to do was revisit those periods of dabbling in the market and what I heard and learned as a younger person, and try and do it in some sort of systematic way that I could make it work clearly. And so right from day one, I said to myself, if this doesn't work, I'm going to have a pretty meaty mortgage that I'm going to have to work off over many years. And if it does work, well, then I, stand to offer my family a kind of at least a middle-class lifestyle that I was hoping to be able to do. So that was, right from day one. Could I have lost it all? I suppose I could have. I would have been pretty miserable and unhappy, and it would have caused some concerns. But it wouldn't have been a death blow, if you know what I mean. It would have just been carrying around a larger mortgage debit. And so I set about trying to figure out how I could possibly do this and make it work. And I very, very early. So one thing I did from a very early point is I subscribed to a Stockwatch service that I managed to find. That Stockwatch used to publish a book style hardcover or hard copy that they would mail once a week. And in that book was every single press release that came out on the venture, or at the time it was called the Vancouver Stock Exchange.
And this is mid-90s we're talking?
Yeah, early 90s.
Early 90s.
90, 91. This thing came in the mail every week, and I read it cover to cover. So I literally pretty much read every press release week after week after week. And even more valuable than that was that there was an editorial at the beginning. So that would have been 6, 7, 8 pages of information about what was going on the exchange, what the big movers were at the time, who was behind them, and so on. What I really liked about the hard copy was that each stock had a list of the directors underneath it, the price, the issued shares. So it was a fantastic picture of what that company was all about right there. You didn't have to go searching. And so after continually reading this, names started to sort of populate in my brain. Like these names kept coming up.
Over a period of months or years, Mark?
Well, actually years, more like years, but let's call it a couple of years. Things started to really become very clear to me, that there was a certain population that was really creating a lot of the movement, a lot of the wealth, if you like, a lot of the attention on the exchange. But I think my most valuable takeaway from this process, Bill, was that I saw that back in those days, there were no CPCs. CPCs are, I'm sure you and your listeners are well aware, they're manufactured shells, right? That have come. They're the mini SPACs in Canada, if you like. They're the tiny versions where companies will raise anywhere from maybe 200 to 2 million kind of range, 200,000 to $2 million range, and look for projects. Those didn't exist. So what existed primarily at that time was that companies were getting new lives, a new shot by being rolled back, cleaned up, and reinvigorated, often with new management, new projects, et cetera, et cetera. And so I found that most of the big movers that I kept noticing over and over and over were these reorganized companies. And so I set about a very stringent process where I would mark pages, and at the end of my reading of this whole thing, I pulled out a notebook and I kept track of every single reorganized company. So the standard in the day pretty much was there was nothing like today. There were many less shares issued for many of these companies. So you would have a lot of companies that were listed post rollback, post reorganization, that would have 1 to 2 million shares out, and that was it. And so that became the population that I was really most interested in, because I thought, well, these were in essence, they were dead companies. They're being reorganized. Somebody's paying the listing fee. Somebody's taking care of the filing. Somebody is going to this effort. Why are they going to this effort? Well, they're going to the effort because they're going to revitalize these companies. And so I set about accumulating very quietly off my list that I created bits and pieces of these shells, over weeks, months, and in some cases years, because it's a slow process. So it took a tremendous amount of patience to go about this task.
And Mark, could you share a little bit about how you use that home equity line of credit? So you didn't have a lot of money you started with. You had to borrow from the bank. So how did you manage the risk of the fact that you were playing with borrowed money?
I tried to be as careful and cautious and thoughtful, and utilizing some basic sense of how to deploy capital in a proper way. And I really knew nothing, but I just was a fiend for reading, listening, learned wherever I could. And I think one of the primary sources back then was John Kaiser, who I believe you've interviewed. And well, John, back in those days, he had a bottom fishing list, 100 bottom fish. And so he was doing the same. As I realized after this short period of time, John was doing a lot of this similar work on a clearly more professional level. He was a broker at a brokerage firm out west in Canada, and his work was scrutinized and so on. But I learned a lot from John and from the work that he was doing. And I suppose one of the things I learned was, don't throw your eggs in one basket, the old common saying. Some of these old sayings come about for good reason. And so to answer your question, I diversified quite, like mindfully. Like I made sure that I didn't, buy any one stock to a great degree. And so, I guess it was the early formulation in my mind of how to properly allocate capital. And I would just generally say that from that point of view, nothing much has changed. I think 5% of your capital is a big position. 2% is probably about right. And yes, you'll break that rule now and then, and you'll have a high conviction name, let's call it, and go a little bigger. But so that's how I try to assure that I would be successful. So I was dealing with very risky, a very, very risky playing field, as we all know. I mean, this is verging on insanity. I mean, why would anybody, swim in a shark-infested water? And I knew that it was not going to work, unless I determined, what would result, in a successful outcome. And so another part of that was, again, by using this, this weekly and deciding I was going to focus in on these 1-2 million share shells. I knew that, like, over time, they would be brought back into some sort of activity. But we were talking about market caps of $200,000, $300,000. That was, so they were basically trading for what, if you wanted to start a new company today and you went and hired a lawyer and an accountant, and that was in essence the market cap of these things. So, they don't all work, and they didn't all work, but in a way, you sort of said to yourself, it's going to be a little difficult to lose money here.
How quickly did success come to you? You're not ostentatious in any way. You're very modest, but you've been very successful. Can you talk about how quickly success came to you, and via what shell?
Wow. Well, I would have to say that even in those days, I didn't have a losing year, but it did take probably 3 or 4 years before it started to become in any way meaningful. So that was almost like an incubation period, where you're collecting these crazy shares in these crazy little companies. It would seem like it would be a very difficult thing to explain to anyone. This was not dinner, this was not dinner conversation. It was an unusual activity. Let's put it that way. And I was quite aware of that, but.
Do you think you confused a bull market with brains, like Rick Rule said, or were you able to keep your ego in check? Because if you had those initial years of success, you didn't get pummeled yet to kind of humble yourself. How did you manage that?
I think largely by sticking to the same general methodology. So, when conditions would change and market caps would rise and there was a lot of excitement in the market, I would not get drawn into it. I just refused to really get drawn into it.
Is that your personality, or how did you develop that trait?
It's personality. It's contrary thinking. It's determination in sticking with something that I felt very strongly was going to work. And so I looked at it like, I'm not going to be the guy that's going to go out and pay massive premiums to get involved in these little public companies. So again, I would look for cash-rich shells in particular, especially in times where the market was a bust. So, sometimes literally companies would trade for less than their bank account. And so once again, I would say to myself, how do you lose money here? Well, I found out there were ways. Occasionally things just don't work out, no matter how much work you do. But the greater percentage do work.
So so your strategy is here that you're articulating is get in early, right? And
absolutely, get in early. Occasionally now I'll get a phone call from a company and they'll say that, well, it is early, Mark. It's only 50 million market cap and we only have 100 million shares out, and I'm polite, etc. But I get off the phone and, well, that's not early. That's just not early. So sticking to my guns, sticking to early stage, not overpaying for things, being around when nobody wants things, really, Bill, is what it really boils down to. I want to buy things when nobody cares.
And Mark, so we're mid 90s now, and you're starting to taste success. The information sources, this is kind of like when the internet is starting to come up. So perhaps there's more sources of information that you're consuming at this point, mid 90s. Would that be right?
I think it was a little bit later than that, perhaps just a little bit later. You might be right, but mid to late 90s. Now I no longer have to go to the library to dig up microfilm and old versions of the Northern Miner to find out information. Sure.
And that was part of your due diligence then, going to the library and looking at microfiche, which many listeners may not even know what that is.
Literally, that's what I used to do.
So
I spend an afternoon in the library.
What about intel that comes person to person? Were you developing your network during this period of time too?
So when Windows came along, and I was a PC guy, and Windows came along, and the earliest form of sharing and exchange was called news groups. I don't think they're around any longer, but they were one of the early forums on the internet. And so I recall joining a news group, and it was called Stockman. And I became active in reading and occasionally posting. And so that was my very first straying into the sort of becoming involved with people and building relationships. And I actually still remember that I was sort of taking a bit of a higher profile, I suppose, through this group. And so I became part of a more active few of us. And so somebody found me one day who ran a company, and it was the same kind of conversation I was just referring to. They basically phoned me up and said, well, any chance that you might pitch this story on this news group? And he told me the detail. And I basically said, well, you've got a lot of capital. You've issued a lot of shares already. You're sort of hand to mouth in terms of finances. You've got a very small deposit in Manitoba, which didn't excite me. I'd already kind of learned enough about those things that that was going to be a tough sell. And so I said no in as polite a way as I could. And actually what I found is that gentleman, I had gained his trust or admiration, or I'm not sure what the right word is. Like he actually respected me for saying no. And which always told me that, he on some level he knew, right, that and actually we're friendly till this day. So that was one of my first building a network experiences. And then it really does go from there. So
and then how did you utilize a network, or how did you develop your discernment of who you should partner with for an investment and who you should avoid? Can you talk about the process of learning?
Well, I think it all goes back to that early work, right? So you tried to associate yourself as best you could with people who were successful in the industry. And what I've said jokingly a few times in the past is I like to find the wealthiest people, the most successful people, and then find their absolutely earliest stage deals, their earliest stage efforts, and see if I can get myself involved in them. And so, so you show up at things like PDAC and you shake some, but you're selective in where you decide you're going to go and have a conversation. And you've already predetermined, these people don't know you, but you feel like you know them because you know their history, you know what they've achieved, you know that they're the right kind of people. And so I would go to meetings, I would go to PDAC, and I was also never shy to pick up the phone and phone people. And so, again, using a sort of selective starting point.
Mark, there's a lot of listeners that are listening to us right now, and they are starting with nothing where you were, and they're not accredited investors. Were you an accredited investor, or when did you become an accredited investor? I guess, can you succeed with this method if you're not an accredited investor?
Absolutely, yes. I don't see why not. Things have changed. There's no question that they've changed, but it's still possible. They haven't changed that much. And so if you'd like, I can try and address why I believe that that's the case.
Yes, please.
Okay. So there's such great resources now. that you can literally not have to leave your house, not pick up the phone, not have much money, and do tremendous research and hone in on some very, very good ideas. Starting off with, I would say, for example, stockwatch.com. Now, I'm not here to sell Stockwatch. I'm a subscriber, but I would have to say that that is the most terrific resource that an investor could hope to have. So getting back to your point, if you have no money, you shouldn't be in this game, period. Like this is not for the no money people. You should have some capital that you're willing to risk, and you should be willing to lose it, frankly. And so we have to start with the starting point of saying you have a small amount of capital, let's say. If you want to put a number to it, point being spending, let's call it $100 a month or thereabouts, shouldn't be a backbreaker. So for that level, you can get a pretty high level subscription at Stockwatch. And what does that give you? Well, it gives you the ability to follow companies, to get their press releases, but much more importantly, they have excellent databases. So for example, you can click on something called participants. You can go in there and you can pull out some guy that you know has been very successful. Let's call him Lucas Lundin. And you type Lucas Lundin into their little participant search engine, and you will get every single company that he's ever been involved in and is currently involved in. And so what great starting point that is. That hasn't changed since the early days of me doing this, only now it's simpler and easier and cheaper.
And so today, that's how you find investments then, using Stockwatch?
I still use these same, since that service started, which was sometime in the late 90s, I still use many of the same products to help me in finding these opportunities. So I'll look under participants, right? Second, or even more, and maybe even more importantly, there's a gold summary that comes out. I think it might be every day or every few days. There's a gold summary. There's a shell summary. There's an energy summary. They do sort of terrific in-house research, and they're all written, very accessibly with a little bit of tongue-in-cheek and so on. And nobody's trying to sell you anything. It's just information in a very consumable fashion. And so Stockwatch, I would say, would be a number one stop for someone who's just getting started.
Okay, so you use that to screen initially, and then if it passes through that filter, what's your next step of due diligence?
Another thing that I do very early on, another subscription. I'm going to mention another company. I'm not affiliated. I'm just a very
nor am I.
And I will tell you that it's what is it? It's not $1,000 a year. It's under. It's somewhere in the perhaps $500 or $600 a year range. Ink Research. INK Research, another fantastic tool. So now you've picked a stock you like. You can go into there and you can create a basket. And so you will be delivered into your email anytime an insider buys or sells stock. That's one thing they offer. I couldn't own a stock without having that service. There's many ways of getting that information, but that's the easiest. You will get an email delivered to your inbox in the morning that will tell you, that so-and-so bought or sold shares the day before. So as a rule of thumb, when I invest in a company, the next thing I'll do is I'll go to my account and I'll add it in. And so now I'm watching what the insiders are doing. I've learned about the insiders from Stockwatch, let's say. I'm now at Ink Research. I'm watching what they're doing. I don't want to, you see a stock go down. The first question you're going to ask yourself, well, why aren't the insiders buying? Well, I'll have the answer. Maybe they are. Like, let's see what they're up to. If they're not, that's information, right? It's valuable information. You want to know you want an answer to that because you want to be very aligned with them.
And if you invest and look for early stage opportunities, are these all exploration plays, or what type of mining companies have you invested in?
Well, sometimes they're literally nothing but a shell, but they're going to be directed to a mining project. Sometimes they're reorganized, as I was saying, or I think one of the things you learn very early when you do this, and I believe you should, is where is this company in the life cycle of a junior company? And it's quite clear to me that there's an early stage, a middle stage, and a late stage. And so I've been one to sort of concentrate on the early stage. So sometimes a company's been around for a while, but you could still define it that way if it's more or less inactive and has a treasury. I would still call that. So I'd be looking sometimes for, let's say, shells with the right people involved, or, for lack of a better word, a busted company, but it still had good structure. In other words, there weren't a lot of shares issued. It had good structure. It had good people. It may have been lacking in the project area. Sometimes it had a great project, but it was so out of favor that the market was attributing zero value to it, or near zero value to it. And we saw a lot of that, by the way, in 2016. I would still say these opportunities are out there, and they're available.
Is it as easy to bottom fish today as it was in the early and mid 90s?
Well, that's a good question from the point of view of what I described earlier. You can't do exactly what I did earlier because now we have the CPC world. And so many more shells. There are still shells or companies that will get rolled back and sort of take on a new life and so on. Yes, those are still out there, but not in the quantity that they once were because of the manufacturing process that's been developed, which we know is the CPC. But how can you take the work I used to do earlier and do it today? I would say you could do that same kind of work on CPCs. So there's perhaps call it 300. I may be off here, but there's several hundred CPCs out there. They trade. They're on the market. They are, in many instances, the modern version of what I did. So if I was starting out today, what would I do? I would have a spreadsheet. I would list all those CPCs. The next column would be how many shares are issued, who's involved in these CPCs, what kind of talent are we looking at here, what's the market cap, and I'd have a screen of them, and I'd be waiting for the opportunity for them to trade around the level that meant that you were basically just buying the cash in the treasury.
And so when you do that today, are you buying in the open market then your position? You're just nibbling away at to develop a position, or are you doing that through a private placement?
I'll buy in the market. As I said, I would also suggest don't be afraid of picking up the phone. So sometimes you can get yourself involved with there are several brokers that do a lot of CPCs. You can get your name on the list. You can do that as a starter type position, and then you can go and buy in the market. And sometimes there's distressed sellers in the market, so you can actually pick up a meaningful position. What is your combination?
Combo, okay. What's your biggest mistake in this method of speculation? And can you name a name and give us the autopsy, please?
Well, there's a lot to pick from, Bill, because you make a lot of mistakes. I kind of think of it a little bit like, I like the baseball analogy. You can be the star of the game and known as a great hitter, but you strike out 2 out of 3 times. So I tend to look at it very much, that way. And anyway, to not stray too far from what you're asking, let me think. There are some pretty brutal situations that can occur. I can think back of one. I'm a little hesitant to mention too many names here, and I don't want to offend any particular groups or people, but I did have a fairly meaningful position one time in a company called Angus Mining, which I had done all my homework on. It was actually very well run in terms of people and their qualifications for making this work. But it ran into a really bad market. The first project just didn't work. There was no appetite for a reorganization, and it basically was delisted. So in a case like that, you can actually lose all your money, every penny.
Were there warning signs you missed, or is it par for the course? You get
no, there was really not much that could be done about it because it happened over a period of really a couple of years. And this sort of 15-cent price was a dime, and then it was 8, and then it was 5, and there was no volume. And you're kind of sitting there going, well, there's not that many shares out, and these guys are capable, and but they just didn't push the button on getting it revived. And I know some of the backstory there. And I think this was also a time where they were having much bigger problems. They had large undertakings that were really struggling. And so the particular group just didn't, they weren't able to revive that situation.
What about some of your winners, and how did you execute your exit strategy?
Yeah, well, I'll go back to the early days. There was a small group out of Vancouver that had at least 5 or 6 shells, and they were putting out these little press releases, basically saying that we're looking for an acquisition, whether it be mining or elsewhere. And so I thought, well, this is exactly what I'm doing. I need to own them, and I need to own all of them. And so I bought shares as I could in the market. And there was one particular little company, which will certainly put a little smile on your face, but it was called Thumper Resources.
The rabbit as a logo, or
there were literally 1.8 million shares out. I still remember that.
Oh, wow.
And so I'm picking up, so what are we talking here? We're talking like if you're buying shares for 6 to 8 cents, you're paying $200,000 to be an investor. You're paying the cost of the listing. And so I knew they were looking for an acquisition. That was no secret. They were actually telling me that in a press release. And so I'm accumulating these shares. And at the same time, I call up management periodically. So I'm on the phone with them. And one day the stock gets halted, and they're doing an acquisition. And I was absolutely shocked that they were doing a 1-for-3 rollback. And I thought, you have 1.8 million shares and you're rolling back, 1-for-3. So I'm going to end up with, so, if I had 100,000 shares, I'm only going to have, 33,000. What's up with that? You have the smallest number of shares out that I could find anywhere listed. And the gentleman on the phone just said, well, don't worry. I think you're going to be very happy. So, that stock went on to become Arequipa. I've never known how to quite pronounce that, but Arequipa Resources, with a Peru project and some real heavyweights on the board, including Catherine McLeod, who came from a very, McLeod family is quite well known in the market. I'm sure you've run across them. Sabina, for example, is run by Bruce McLeod, who's her brother. So I was very happy. This thing, at the end of the day, it was sold to Barrick, by the way, for $31 a share. So now, did I last that long? No, I didn't. I think, and you're asking me, how do you plan your exit? Well, that's the really tricky part. Buying stock is actually quite easy. Selling it is the hard part. And I've heard way too many stories of people waiting way too long. And I've been a victim of that myself. And so I guess at that point, I just knew by around $3 a share that I had a nice run, and that was fine. And I sold it and I moved on.
And what was your gain? What was when you did all the math, what percentage gain did you get on your capital invested?
Well, it was over 10 times.
In a period of how many years or months?
I guess that probably would have been over a 3 to 4 year period. Yeah, 10 bagger in 3 to 4 years. So again, if you I like to just annualize and say, well, okay, if this takes another year, if it takes another 2 years. So again, you need patience. This is a game that requires a lot of due diligence and a lot of patience.
So if you're talking to a Bitcoin millionaire, or I see these younger people online that are trading on these apps that don't charge them anything to buy and sell call options, and they're making a killing, and they started with $1,000, now they're up to $250,000. What advice would you give somebody that's experiencing quick success via whether it's cryptos or call options?
It seems to me that quick money comes and goes. So there will be cases of some of those people who will be smart. But on the whole, I think it's dangerous. It's very dangerous. You lose money, you learn. You make money, you don't learn. I really don't think you learn much when you're correct. You learn something when you're wrong. And look, I mean, I don't wish them any. I hope they're all, very successful. But I would be concerned. I would think that there might be a day of reckoning, and I don't know what would bring it on. And I'm not one to say that cryptos are worthless. I'm not in that camp. I actually do think that there's a lot of validity and there's a future. And we're actually going in that direction, clearly. I think crypto and blockchain are very important. But they'll get overheated in the same way that penny stocks will. And so if you're buying at the top, you're in trouble. And you don't know until it's too late. And my problem with it is that it's very hard to value these things. So some of the larger coins, for example, have very good projects and could very well be around for decades and become part of the system in a bigger way than we could even imagine right now. But a lot of the other coins will disappear, and there will be fortunes made and fortunes lost. So.
And Mark, you've made a fortune, although you're not ostentatious about it, like I said, but you actually do this because you enjoy it, right? It's just the love of the game, so to speak, is why you do what you do.
Yeah, I enjoy it. I really enjoy it. I mean,
is it the process or the freedom that it's given you, or both?
I think the freedom is really important, and I think if you enjoy the process, well, then you're quite fortunate, And please, understand there's stressful times. There's very stressful times, when living through something like 2008 was a stressful time. Living through March of 2020 was a stressful time. These are difficult times. But again, here's my question. How can you define yourself as a value investor when you're playing in such a dangerous area? Somehow or other, I do see myself as a value investor.
Not a speculator? You don't think what you're doing is speculation?
Well, it is speculating, but I'll just give you another example. In 2008, I was aware of a company that had $1 a share in cash and no debt, trading at 40 cents, trading at 50 cents. So, yeah, what do you call that? Is that speculating? I'm curious what others would say. Yes, I suppose in some ways it's speculating, but in other ways, I'm buying $1 for 50 cents, and I know who's running the company.
Well, that's the key, right? Because I've been told $1 per share cash in the bank in the hands of the wrong people is worth zero.
Well, you're absolutely correct. And in this case, one of the large shareholders was Seymour Schulich. Another one was Frank Mersch. These are well-known names. They weren't going to be in a company that was going to put that through the back door. So I'm using a very successful, example. But again, that example existed. It was there. It was there to be had. You had to have the courage at a time when markets were, imploding, to say to yourself, I'm going to buy this $1 for 50 cents in spite of what's going on in the world, because I know one day that will change.
As you built up your net worth over a couple of decades, was it just the compounding nature of 5 and 10 baggers, or did you have any 100 to 200 baggers in there also?
There were a couple of outstanding wins. And there's one that's sort of still ongoing, if you like, where it's been a many multi, I don't even know what the number would be. And I'm still involved in the stock, and I'm okay to talk about it, I suppose, briefly. But I was, so 2010, 11, 12, actually be more specific, 2012 to the beginning of 16 was one of the worst bear markets in the history of junior markets. And so that was at a time when, every time you picked up the news, there was another fund that was basically saying we're selling all our mining stocks and we'll never put another penny in. And they would change directions. New funds were starting up, and they would have a policy: we don't invest in mining. Oh, that's good, because most investors would take that as great news, because the gold price lingered and drifted for that period of 4 or 5 years, and it was just a hated sector. It all changed in January of 2016, and we had a really nice period there for a while. But the point being is that if you had capital during that period, and again, going back to the very beginning, and you were asking, how do you apply it today? Well, that period from 2012 to 16, you could go and buy mining companies that had 10 cents a share in cash that were trading at 8 cents a share or 12, or a modest premium, to what their liquidation value might have been. And so at that time, I was collecting shares in a little company called Orion Resources. When I first was buying it, I believe they had about 10 cents a share in cash. They had about $4 million in cash, but nobody cared. Nobody wanted to know about it. Nonetheless, Rick Rule was a shareholder there were some quite well-known guys that were involved, and there was a very good geologist involved. And so that was one of those crazy little stocks that I just, just kept accumulating. And fast forward to 2016, or it might have been 17, that the shares that actually bottomed at 3.5 cents hit 3.50. So that comes to mind as a large win, and a many bagger, a multi. And so I still, clearly I took some money off the table, a fairly substantial amount, but to this day I'm still a shareholder, and still have a very meaningful position, and in fact recently bought more.
And because of your success too, you've had, after a couple decades, then funds began to reach out to you for strategic advice, didn't they?
Well, yeah. I mean, in 2011, I was starting to have various friends and associates ask me if I would get involved with them, and find a way to help them with with this business of making money in the market. And my answer was basically, well, no, I can't do that. But in looking around, I was fortunate in finding a company here in Toronto that was sort of looking for somebody like me, and we ended up teaming up. And so, for the record, I'll just say I'm not a registered portfolio manager, but I work with one in a fund that I'm the analyst advisor for. So the trades are made alongside a portfolio manager that has the final say and approval or not on what we do. But so as of January of 2012, I've been involved in this fund, and it's been attempting to pursue exactly the same strategy that I've always used. And so, they had to look at my track record. They didn't have anybody in the space, and we, mutually decided it was a good fit.
And how do you like that compared to just managing your own money for the first 2 decades? Is there added stress or anxiety involved in that?
100%. I feel way worse, when things aren't going well, with other people's money. So I am the largest investor in the fund, and I treat it like my own. And I really, some funds, I think, I would say some funds make it, it's hard. It's easy to get invested in them, and hard to leave. And I like to try and look at it the other way around. I really try and make sure that there's a good fit, so that, again, let's say you're a sophisticated investor and you've got $1 million to invest. I would not want to see you put more than $50,000. So, I'm a registered EMD, exempt market person. And part of the reason I did that is that I could actually, legitimately speak to people about their investments. And so that's the kind of advice I would say. Don't put more than 5% of your net worth in this. In spite of the success, I mean, it's just not, it's just not the right thing to do.
Even though that's not what you did when you started out, right? Just because most people aren't willing to do what you did and aren't wired like you're wired. Is that why you would say that?
I would say that, yeah. I mean, do not do what I did. And if that's a hypocritical statement, you have to know yourself, and you have to you have to be ready for the worst case scenario, which I was, and I legitimately was. But there are people, and I've experienced it now. I've seen a 10 and a 20% drawdown, and I've handled some of those phone calls. And it's clear to me that in retrospect, there are investors who just simply are not programmed to manage in those situations. And so, as I say, there has to be a good fit, and you have to be ready for the roller coaster. But if things work, then, you get higher highs and higher lows, and you can't hope for better than that. You can't short circuit the process of, going through the ups and downs of what a junior market will feed you. In spite of all the due diligence that you can do, it's not something you can avoid.
That's exactly right. And I've experienced that in my own portfolio. You're up tenfold, and then there's a 60% drop in the next 6 months, and you're pulling out your hair. So it just comes with the course. So you said most people shouldn't do what you did, but there's going to be a lot of listeners that just listen to this hour conversation that want to do what you did. is there a way they can follow you? I know you keep a very low profile, but is there anything you'd like to share about how people can find out more about you?
Yeah, I'm not really much of a poster anywhere. The only thing I could suggest is if they want to go to spartanfunds.ca and look up the Taraz Fund, they can subscribe to a little monthly one pager, and at the bottom of it is a little commentary that I'm involved in writing, and I've been sharing bits and pieces of a process since 2012 on a monthly basis. So I like to think that something in the way of what's, the sauce that's involved in this is spoken about and why it works. And so, if people want to subscribe to that, it's free. There's it's
no commitment needed.
No, yeah. There's nothing at all.
Well, Mark, this has been a great hour. Thank you for sharing your story. You humbly shared your story. Others would have shared their success if they had your success in a much more ostentatious way. So I just appreciate you coming on the show to inspire and educate my audience. And again, just thank you for coming on the show today.
Well, thanks, Bill. An hour can go by very quickly. But I also want to thank you for the great work that you do. Your interviews are top notch. So I hope this has some value to some investors.
Absolutely. And thank you.